Hi. Most FP&A teams today still forecast revenue the exact same way they've done for decades. Take a trend line, extend it forward, and let the mathematical shape define the future. On paper, it looks intelligent. On a spreadsheet, it looks elegant. In a meeting room, it sounds highly convincing. But here's the truth. Trend-based FP&A model has mathematical neatness, but operational inaccuracy. It looks precise, but behaves unpredictably. It gives an answer, but not the right answer. It forecasts the future, but not the one the business will actually experience. To be fair, trend-based models have a place. In a stable, low-complexity environment where revenue isn't constrained by people, delivery time, and operational throughput or sequencing. But the moment you step into any real business situation, subscription-based, transaction-based, or most visibly professional services, they collapse spectacularly. And here is why. Even though different revenue streams look different from the outside, they all follow the exact same underlying truth. Revenue is never, ever a statistical event. Revenue is an operational outcome. And nothing exposes this more clearly than professional services, because this type of revenue stream, the business logic is naked. There is nowhere for the model to hide. Professional services isn't seasonal. It doesn't self-correct because a curve says it should. It doesn't follow a pattern. That conveniently extends into the future. Professional services revenue follows the business operations exactly the same way. You hire a person, the person ramps. The person is allocated to an engagement. The engagement is delivered. Delivered work becomes billable value. That value becomes revenue. That is the physics of the business model. And physics cannot be trend-filled. And here's the part most organizations never articulate properly. This isn't unique to professional services. Professional services just makes the problem impossible to ignore, because subscription revenue, on the other hand, only exists when customers are onboarded, retained, renewed, or expanded. That's it. Transaction revenue also exists because inventory, logistics, throughput, and customer actions make it possible. Professional services revenue only exists because human capacity delivers work. Different revenue streams, same fundamental equation. Operations, delivery, revenue. That's it. Trend-based forecasting ignores all of this. Driver-based and position-based forecasting models it faithfully. The very moment forecasting begins with a trend line, four things break instantly. 1. It assumes capacity expands in perfect synchrony with revenue. That has never happened in any real company. 2. It assumes utilization, productivity, and delivery mix stay constant. They never do. They move weekly and compound into margin swings. 3. It assumes delivery timing is smooth and predictable. Client onboarding delays, scope shift, overruns, choke points, none of that behave in a smooth line. And 4. It forces the P&L, balance sheet, and cash flow into post hoc alignment. Because if revenue is an input instead of the output, every other number becomes a backfill exercise. The financial statement balances, but they stop being true. A driver-based position, the FP&A model, begins where reality begins. Roles, capacity, utilization, delivery, revenue. It doesn't project an outcome and then work backwards. No. It models the operational truth and lets the financials emerge. Here's what that means in practice. It counts real positions. It prices real hours. It models hire to ramp timelines. It tracks supply and demand. It allocates delivery capacity. It recognizes revenue only when delivery is actually possible. This isn't more detailed. It is just structurally correct. Cost of revenue stops being a guess and becomes a consequence. Revenue stops being a curve and becomes earned value. Margin stops being assumptions and become real operational performance. Nothing is assumed. Everything is generated. This doesn't just produce better numbers. It changes the role of FP&A itself. Trend-based FP&A predicts numbers. Driver-based FP&A predicts the business. Trend-based FP&A explains variance after the fact. Driver-based FP&A prevents them. Trend-based FP&A reports what happened. Driver-based FP&A shapes what will happen. One lives in output, the other lives in reality. Revenue is the perfect place to see the difference because it is the most sensitive to operational truth. It collapses fastest when the methodology is wrong. It exposes assumptions instantly. It drives the P&L, the balance sheet, and the cash flow. It ties directly into hiring, cost of delivery, and run rate cash. When revenue is modeled the way the business actually earns, FP&A becomes predictive, trusted, actionable, respected, and you know what? Indispensable. So, when you see a forecast that begins with a trend line, understand this. You are not looking at the future. You are looking at a mathematical construct. But when you see a forecast built on roles, capacity, utilization, delivery, and operational reality, you're looking at the business as it actually performs. This isn't a theoretical. It's not a framework. It is the way revenue is earned in every real business. And once FP&A models revenue the right way, everything else falls into place.